Hey everyone, it's Christina from the Lagom group. Today I want to talk about what's happening in the agricultural real estate market, particularly here in the Niagara Peninsula, but also how this ties into what we're seeing across Canada. Niagara has always been a special region for agriculture. Fertile land, a strong wine industry, and a location that gives it easy access to US and international markets. But right now, buying or selling farmland isn't as straightforward as it might have been a few years ago. There are a lot of moving parts. Interest rates, trade policies, global shipping, you name it. So let's break it down. First off, let's talk about borrowing costs. You've probably heard that the Bank of Canada has cut its overnight rate twice this year and has since then held steady. Normally, that should mean that it would be cheaper to borrow. However, here's the catch. Long-term interest rates haven't followed suit. In fact, they've been creeping up. Why? Well, that's because those long-term rates are influenced less by what's happening in Canada and more by what's happening in the US bond market. Investors are demanding higher returns to lend longer thanks to trade tensions, US budget issues, and general uncertainty. So that means for anyone looking to finance farmland purchases or expansion projects in Niagara, this means borrowing is still expensive. The broader economic outlook isn't exactly sunny either. Canada's economy grew in the first quarter, but the forecast for the rest of 2025 isn't great. Growth is expected to slow to around 1.1%, which is one of the weakest rates we've seen outside of the pandemic. So why does this all matter for agriculture specifically? Slower growth usually means softer commodity prices and less demand. At the same time, a weaker Canadian dollar caused by our economy underperforming and US rates staying high makes exports more competitive, but also raises the cost of imports. Now this is including equipment and inputs. Now let's layer in trade. The ongoing US-China trade tensions are shaking up global chain supplies. Tariffs, new shipping fees, and rerouted freights are... So here's an interesting twist. The US has introduced new fees on Chinese-built ships starting late 2025. These fees could hit US exporters hard because they'll face higher shipping costs, especially during peak export seasons for crops like soybeans. And here's where it gets interesting for us. Some of that trade may be rerouted through Canadian ports to avoid those fees. That could be a win for Canadian exporters, including farmers and agribusiness in Niagara. It's one of those rare cases where someone else's problem creates an opportunity here. If you're buying farmland, higher borrowing costs might make the math a little tight in the short term. But with strong fundamentals and the potential for export growth, the long-term outlook is still attractive. Now, on the flip side, if you're selling, the market is still active. Good properties, especially vineyards and high-quality orchard land that's priced right, continues to attract interest, particularly from buyers who see the bigger picture. The key right now is to stay informed, be strategic, and think long-term. The agriculture sector has always been resilient, and this period is no different. So to wrap things up, yes, financially it is a bit tougher right now, and the global trade environment is messy. But these same challenges are creating new opportunities, especially for those who can adapt. For Niagara and for Canada as a whole, agriculture remains a cornerstone with plenty of room to go. Curious about what's happening in the market and how it might impact your plans? We'd love to connect. Send us a message or email anytime to start the conversation.